Well, maybe I should ask, how many of them are there now? So let's start. Good afternoon, all of you. And again, as I said to Chan, I would have loved to be teaching directly in Vietnam physically. You know, it's a bit tricky to teach online like this, and I guess that you would also prefer to be in the class with me to have a closer relation with more potential for discussion and questions. Okay. Nevertheless, just a few things. I don't think I need to take too much time to introduce myself. I just put a picture, which is not what I'm doing usually, but since we are not meeting physically, I thought that at least you should know how I look like. This picture is not too old. Well, so as you can see here on the screen, I am a professor at ESCP Business School. I would say I am now an emeritus professor, meaning that I am retired officially, but I'm still working with the school. And I was part of the finance department, which explains to a certain extent why I'm teaching this course today, because insurance is a topic which I have been interested in for years. Okay, and as you can imagine, it is part of the financial domain. Well, maybe I should add also that I know very well your program because I'm the one who, together with Joël Mété, I don't know whether you met Joël or not, because I know that he's not coming to Vietnam anymore now, but I did participate in the launch of this program, so I know it very, very well, and it's always a pleasure for me to come back to your program and have the opportunity to teach and to follow your progression. And I'm quite happy to see what the CFVG is today and what the MEBF has become in Vietnam. Okay, so having said that, now what are we going to talk about? I think I don't need to insist to convince you that insurance is a very important field as far as the program is concerned, because indeed, banking is much more developed. I mean, you have several courses which refer to banking, and you are usually familiar with banking activities because we all need banks, you know. Whereas the activity of insurance companies are not that well understood usually. And even for people like you, for specialists, my experience is that your understanding of what the insurance business is all about is very limited. So the very first objective of this course, which is a kind of rather, let's say, a kind of minimum which we should achieve, is to make sure that at the end you have a clear understanding of the specificity of the insurance business, but also of its importance, particularly in a country like Vietnam, which is a fast-growing country where the needs for insurance are growing dramatically, and which means indeed that insurance is a field with a lot of opportunities for people like you. Okay, so having said that, and I will try indeed to provide you with all types of arguments to convince you of the importance of this insurance business. Well, so to be more precise, what is the course content? What are we going to talk about together? An introduction indeed, because we always need to start with an introduction, but I will use this introduction to give you a brief presentation of the insurance business to start with, and also to argue, to show to demonstrate the importance of this field, particularly for Vietnam, as I said. Then we will work on the business model of insurance with an approach you are familiar with, which is the portfolio approach. Okay, why? Basically, to make it simple, or well, not that simple, but simple for people like you. I'm pretty sure that you have heard of ALM, Asset Liability Management, which is an approach which is very much used in the analysis of the banking activity. But here, it's the same approach. It's a kind of ALM approach. We'll see that insurance companies, if you look at their balance sheet, can be seen as a kind of twin portfolio. You have a portfolio of liabilities and a portfolio of assets. And the trick is to manage these two portfolios together to optimize the portfolio structure. So this is, I will be more clear about this today. And it is a key point indeed, because you need to understand that in the first place to have a clear understanding of what follows. What follows will be a focus first on non-life insurance pricing. Non-life, why? Because there is a clear distinction to be made between non-life, which corresponds to usually to what we call property, casualty, and liability insurance. Okay, the coverage for the protection of your assets and your liability potential cost also, which is included in what we call non-life. And we're going to have a technical approach to the pricing issue, because pricing is indeed the basic problem of insurers. How to price a risk, how to price a risk for, let's say, the possibility of a dramatic event with huge losses, but you don't know exactly what will be the size of losses, when it will occur, the event. So how do you want to price it? There is a kind of complexity there, and we need to go through that in this part. And I isolate non-life activities because they are really different from what the type of policies which are showed in life insurance and what the activity of life insurance is. It's really specific and different from life. That's why we need to make the distinction. Together with non-life, as a kind of complement, it is important to look at reinsurance. Reinsurance, well, to make it simple, you have to look at it as an insurance for insurers. Okay? Insurers, when they take risks, they have a limited capacity. Very much like banks, they cannot have more credit than a certain amount, which depend on their level of capital. The capital adequacy rules in banking, you have heard of that. Insurance companies have the same type of constraints. They need a certain amount of equity to have the right, the possibility, according to the regulation, to take risk. Okay, so sometimes they may have to get rid of part of the risk they have accepted in the first place. And how can they do that? Through reinsurance. So reinsurance is a kind of refinancing of the risk of insurance companies. Okay, so there is a lot to say about this reinsurance activity, which is also a very interesting and important activity, which is a global activity. Usually reinsurance companies are doing business on a global scale, whereas direct insurers are usually looking at national markets. Okay, an interesting thing is reinsurance, because of the challenges that the insurance business has to cope with today. Well, there is a need for new kind of solutions, and that's why we have new types of reinsurance organizations or instruments which are growing right now, which is included in what we call alternative risk transfers. Okay, so these parts 3 and 4 mostly focus on non-life. Indeed, life insurance is also a very important field. Life insurance together with pension funds, there are differences. It's not exactly the same, but I think it's quite relevant to look at these two things together. Okay, as you'll see, life insurance is totally different. You probably know that those who are dominating the life insurance business are banks, actually, so that you can see that there is obviously a difference. If banks are dominant on this market, it means that the products sold in life insurance are very similar to what banks traditionally sell when they collect savings from their customers and when they propose different instruments to invest the saving in life insurance being a solution. Okay, so when you look at life insurance, you are mostly focusing on precautionary saving. Okay, and pension funds, well, as the title indicates, it's focused on a very specific type of precaution. It is a precaution for your old days, and particularly a focus on the pensions you may need when you stop working. Okay, so life insurance will be treated apart. Then, at this point, we will have dealt with what I call the liability side of the balance sheet of insurers. Why? Because the focus is placed on risk taking by insurers. They take risks. They sell insurance and they take the risk. Okay? So this is a liability side. Now, when they do so, they collect premium. They collect money. What are they doing with it? Well, they have another activity, which is not strictly speaking of insurance, but which is more like investment. Okay? So the next part will be about asset allocation. They collect a lot of money through the sale of policies and the collection of premium, insurance premium. What do they do with the money? They need to invest it. How is it invested? That's also a very important topic, which will be covered in this part 6, which is dedicated to asset allocation. And then, indeed, we'll see that as far as asset allocation is concerned, they are often quite prudent. They usually have very conservative portfolios. Okay, why is it so? Just because they have to comply with strict regulation in terms of security of the system. They are the obligation to comply with solvency regulation and capital adequacy, which is the point which we are going to tackle in point 7. Okay, as I told you, it's very similar to what you've seen in banking. You have heard of Basel II, Basel III, and the like. Solvency regulation is very much inspired by the same type of ideas which led to the Basel regulation in banking. Okay, and if we have time, at least, or it will be part of the conclusion, what are the strategic trends in insurance? You know, a lot of things are happening now. I mentioned the fact that we have all types of new instruments, new types of organization, particularly in the field of reinsurance. But we can expect a lot of changes. And this would concern typically a country like yours due to digital technologies. We observe today a kind of digital trend in insurance. Maybe some of you have heard of it, the so-called insurtech. You know, you have heard of fintech. Generally speaking, looking at young startups promoting the use of new technologies in the field of finance, but more specifically in insurance, we call that insurtech, and there are lots of them becoming more and more important, and they are changing the game to a certain extent. So I think it's important for us to take the time to say a few words about this. Okay, so here it is. Now I'm talking alone, talking to my screen, which is not the best position for a professor, which is not what we like most. Okay, and the problem is that it's difficult indeed to interact when you are using this process. So what I expect from you is that you shouldn't hesitate to interrupt me. Okay, keep in mind that there are no stupid questions, even though I cannot guarantee the answer. Okay, there are no stupid questions. So if you have any type of question in mind, either because you want me to be more precise about the point, to develop a bit, or because there is something you didn't understand, don't hesitate to interrupt me and ask a question. Okay, if you don't do so, well, I'm afraid that it might be a bit, you might miss a few points, and we would not reach all the objectives we could reach if we have a discussion between us. Okay, so I repeat that, I insist, don't hesitate to interrupt me. I insist because I know that Asian students usually are not quite used to interrupt their professors. Okay, you have seen my colleagues, they probably told you the same thing. We like to have discussions with our students, we like them to interrupt us, we like our students to challenge us. Okay, so don't hesitate. Well, so unless there is a question, I suggest we move to the first step, to the introduction. Any question? Can I go on? I would like to hear a yes somewhere. No? So since I have no answer, I can assume that that I can go on. Well, I will first look at the rationale for insurance purchasing. Why do we need insurance? After all, maybe we can do without it. For years, you know, if you look at the situation some centuries ago, there was no insurance company, and so we could ask the question why it is that now we feel that we need insurance. So the rationale for insurance purchase, I will be very brief on that, is just to give you a kind of brief and superficial knowledge, basic knowledge in risk taking and decision making under uncertainty. Okay. Well, the second point will be a description of the evolution of insurance over years, a short history of the different types of insurance systems to tell you where we are today. Well, then, you know, I will focus on what an insurance policy is all about. The insurance policy is what is sold by the insurance company. Okay. Sometimes we say an insurance contract. Okay. Or an insurance agreement. It is what is sold by the company. And indeed, the company would receive a premium to that. And when the company is selling a policy, it means the company is taking a risk. Okay. So we should look at the insurance policy as a kind of asset which is issued by the insurer to collect a premium. Okay. Banks are issuing a saving account, for instance, in a bank. It's a kind of liquid asset issued by the bank and owned by the household, which has invested in this saving account with the bank. Okay, an insurer, you can compare with the insurance policy. An insurance policy is a saving asset to a certain extent. And through the sale of this insurance policy, insurers are collecting precautionary saving. Okay, so you see, the insurance policy can be seen as a kind of, I will insist on that more precisely, but can be seen as a kind of financial asset issued by the insurer. And more precisely, we'll call it a contingent asset. And I'm going to explain this word contingent later on. Well, I told you that the insurance business is now getting more and more important, particularly in countries like yours, just because there are growing needs for insurance. So a few numbers about it, particularly in your country. Okay. And also, I would like to insist on the fact that insurance is part of the development of insurance is part of the economic development, which is also an important point to understand for a country like yours. Well, and I will conclude this introduction with a clear description of the business model of an insurer. Okay, using some numbers with a very simple, let's say, simulation to simulate the launch of an insurance company so that you can have a clear understanding of what is the business model, what is the structure of the income statement, and the structure of the balance sheet of an insurance company. So this is what we're going to look at during this introduction. First of all, the rationale for insurance purchasing. Why do we buy insurance? Well, let's take a very stupid kind of example and question. Let's assume that you are exposed to a risk with a potential loss of 160,000 euros. Okay, in other words, you know that, let's assume that you have a house, that you know that your house could be destroyed because of a fire, an explosion, whatever you want. And let's assume that you have a historical data about it. You know, an insurance company, they have historical data about the possibility of, about the probability of occurrence of such an event. And let's assume that it is 0.3%. Okay. My question is, would you accept paying a premium of 500 euro to cover the risk? In other words, my question is, would you prefer to keep the risk as it is with the risk of losing 160,000 euros with a probability of 0.3%, or would you prefer to pay 500 euro to cover the risk? Okay. Well, as I told you, it's a kind of stupid questions, but let me ask you whether I try to get to the so the question is, can you see my question? Would you buy insurance? And you have to give an answer, which would be yes, no, or yes or no abstention. Okay. So now I ask you to answer the question. I just have a problem to. So can you see my question? I have a problem to. So I like you to give this type of answer. And now I let you answer. The answers are coming slowly. It seems you want to please me with a yes answer for most of you. I give you another minute. Okay, so let's stop there. Otherwise, we. So okay. So let's show the answer now. You see, the answer is, well, 82% of you said yes, and 18% said no. So now I would like to know why some of you said no. Can you tell me where? Can you hear me? Well, so let's go on. I'm sorry about that, but it seems that either you may not like to take your microphone. So as you saw, most of you said yes, but a few said no. Okay. And indeed, I'm not surprised to see that a majority of you said yes. And you see, you said yes, even though the expected loss in this case, which is 480 euros, is lower than what you have to pay if you want to buy insurance. Okay. In other words, you are ready to pay a certain amount which is higher than the expected loss. And this is the sign of what we call risk aversion. So you see, what insurers are providing, even though it may cost a bit of money because you have to pay an amount which is higher than the expected loss, you accept to pay this amount just because you are not comfortable with the potentiality of a loss. And even you're ready to pay more than the expected loss. And I guess that the few of you who said no, they've made a calculation saying that, well, there is no reason why I should pay 500 euro because the expected loss is 480 only. Okay? These people, I would say, either they are risk lovers or risk neutral. Okay? So those who are buying insurance are typically risk averse. What does it mean, risk averse? And let's try to understand more precisely why people would, in the end, accept to pay insurance and how much, what is the maximum they would accept to pay in the end. Okay? First of all, you know, those of you who have made a calculation with probabilities, saying that the expected loss was 480 and therefore there was no reason to pay 500 of insurance. First of all, they have to consider that it may not make much sense to use the probabilities if the law of large numbers does not apply. Okay? Because in the end, when you look at it, either you have an accident and you have a huge loss or you have nothing. Okay? So what does it mean when you make your decision, really? Whether the probability is 0 or 3%, it means it's very unlikely. So you may consider that you can take the risk. But, you know, using probabilities when you play only once, when the law of large numbers does not apply, may be also a reason to say, well, let's buy insurance. I feel a bit safer. Well, but what we observed, and it's the reason why insurance is seen as a necessity, is that decision makers usually are more concerned with potential losses than potential gains. There is a kind of asymmetry. To make it simple, you know, if you lose $100, you will not be happy. If I give you $100 more, you will be happy. But your increase in happiness, let's say it this way, if I give you 100 more, will be less than the decrease in happiness if you lose $100. There is an asymmetry there where you would be more sensitive to losses than to gains. And that is the origin of risk aversion. How do we represent that in economics? You probably have heard of utility functions already. Excuse me. So the way we deal with that, to represent this idea that people are more sensitive to losses than to gains, we use utility function as what you have here. You know, let's assume that to start with, you have a certain amount of wealth. Okay, Y0. And let's imagine that you can gain a certain amount dy or lose the same amount. In this case, you would be on the right side of Y0 if you gain, and on the left side if you lose. Okay? And if you accept the idea that the utility of your wealth rather than your wealth would be a curve like this, then it represents well the fact that in terms of utility, the loss is higher than the gain, even though the size of the loss and the gain is the same. Okay? This represents what we call risk aversion, which corresponds to a decreasing marginal utility. This curve represents a decreasing marginal utility situation, meaning that the more you have, the happier you are. You know, it's an increasing curve. If you have more wealth, then you are better, you feel better. But if you are already rich, if I give you a bit more, it will not increase much your utility, your satisfaction, if you prefer, just because the more you have, the less the additional amount of money you get will create more satisfaction. Whereas if you decrease, you know, if you lose money, for instance, if you go beyond or below, your level of wealth today, you see, you may have a dramatic decrease in your satisfaction. And that is basically the way we represent risk aversion, and we explain why you buy insurance. Because risk averse people, they feel very negatively. It has a very negative impact in their feeling, in their satisfaction when they have losses. And that's basically the origin. So I will not say much about it. I just wanted to make sure that you get familiar with this type of representation. Probably some of my colleagues have already insisted on this, because it is the origin of all the theoretical development when it comes to decision under uncertainty. Okay? So the conclusion of that is, in the end, decision makers, when they are facing uncertainty, if their objective is to can be quantified in terms of amounts of dollars or euros, okay, they are not so much looking at the amount of money, but they are looking at the satisfaction they get from this amount of money, or the utility, if you prefer, because we use utility function in economic theory. Okay, so it's a satisfaction you get from a certain amount of money which you are considering when you make decision, rather than the amount itself. Okay, and as we said before, risk aversion is due to the fact that if you have losses, you are much more sensitive than when you have a gain of the same amount. Okay, so in other words, your objective, individual objective, is not to maximize your amount of money, but to maximize the utility or the satisfaction you get from the money. Okay, and if you are facing uncertainty with different possibilities, with different probabilities associated with each possibility, then the objective is the maximum of the expected utility of your wealth. Okay, and this is, I'm probably not the first one to mention that to you, because that's the way all the models trying to deal with decision under uncertainty, and that would include models to explain insurance demand and why people buy insurance and how much they are ready to pay for it. Okay, it's based on this assumption and this type of representation of the behavior of economic agents. So I'm not going to comment the details here. I just give you an example. If you take a function which will be the one you have here, well, with few numbers, well, you could see that it is rational to buy insurance in our example here, because looking at the expected utility with no insurance or with insurance, you end up with an expected utility which is higher when you buy insurance, which is why people would buy insurance. Okay? Well, here I just I'm going to skip this slide because we don't have so much time to spend on that point, but it's just a slide that explains basically why there is a maximum insurance premium you are ready to pay. Okay, I'm not going to comment on this, but it is just to show you that we could go further in the analysis and determine a certain amount of premium you are ready to pay to avoid the risk. And in other words, there is a kind of limit to what you're ready to pay. So for those of you who want to go in depth with this, I'm pretty sure that you could find this in your finance textbooks, and you could look at this slide, and I'm pretty sure that you will understand by yourself. So it would take a bit of time to explain with detail this. I just mentioned it to you within the introduction, just to tell you where all the basics of the theoretical framework when it comes to insurance. You may need that if you want to read some specific papers, depending on what you decide to do with your research later on. Okay, but I don't want to spend too much time on that. Okay, well, so having said that, now we accept the idea that people in the wide majority are ready to buy insurance, except if the price is too high indeed. Okay, but they are ready to buy insurance, even though insurance would lead to a situation which is paying an amount which is higher than the expected loss. And it is because of risk aversion, and most people are risk averse. Most people are more sensitive to losses rather than gain. Okay, so having said that, we assume that people would buy insurance. So what do they buy exactly? What is an insurance policy? As I told you, an insurance policy should be treated as an asset, more precisely, as we'll see, a contingent asset, and I will explain why I use this word contingent, to secure net worth. Your net worth is your wealth, that's another word for wealth, okay? And you want to secure it. How can you do that? Through insurance, okay? So let's first of all have a short history of insurance before we talk about the type of policy that are issued by insurance. First of all, historically, and it's still true to a certain extent in countries like yours or all over the world, but particularly in low developed countries or emerging countries like yours, and still to a certain extent in countries like in mature countries like in Europe, well, you have kind of informal insurance. And informal insurance has to do with group solidarity. If you have losses due to any damage, bad luck, and so on, so probably you can count on your family, count on a group of people who would be close to you and ready, keen to help you to compensate for the losses you have suffered. Okay, this is what we call informal insurance. Like you have informal banking. You have informal banking. If you want to launch a new business, maybe you can ask friends to lend you money. Well, or your family. Okay, here the idea is that the family is a kind also of group you can count on to get a protection in case. Okay, so historically, insurance was informal and still to a certain extent today, more or less. Well, the first type of, let's say, kind of insurer which we had in the economic system is what I call the risk taker, and you still have them. You still have them on capital markets. You know, on financial markets, you have risk takers. They are there to take risk. Why? Because they know that you need to take risk to make money. The more risk you take, the more you can expect as a return. Okay, well, so it is a model that still exists historically. You know, just to mention an insurance organization, the Lloyd's of London, maybe some of you have heard of it. The Lloyd's of London used to be, I say used to be, but it's no longer the case, a club of risk takers. You know, it was not an insurance company as we have them today. Okay, it was just a club of people bringing money together and saying, well, we're going to take risk. And for instance, the type of risk that these people were taking, based in London, okay, was financing, you know, big, let's say, businesses, for instance, getting prepared to send a ship across the Atlantic with the hope that they would come back with a lot of treasures that they could sell for a high value and get a lot of money. So it was very much like what we call venture capital today. So, but the first insurance contracts which have been recorded historically were from the Lloyd's of London, and it was more risk-taking rather than pure insurance as we know today. Well, then together with the Industrial Revolution in particular, to guarantee the safety of workers and their health, okay, well, we had the emergence of what we call social security system. Social security system is a kind of insurance. When working, each of us, we contribute, paying some contribution to the social security system so that there is enough money to be used to compensate those who are not lucky and who need the money for their health or just because they have been injured during their work and so on. This is a social security system. It's not pure insurance. It's more an organization of solidarity which includes social transfers. Social transfers, for instance, meaning that if you look at health insurance, if you are in a certain group of age, you will pay the same amount of money to get a coverage, and we are not making any distinction whether you are assumed to be similar to any other person in the group, even though we know that some people will cost more in terms of health. But we want to have solidarity working. So those who have a good health, who are lucky enough to be healthy, well, even though they have they are less likely to be to need money for their health. Well, they still pay the same amount. In other words, you organize a transfer from those who are lucky towards those who are not as lucky. Okay? So you have social transfers which are organized through social security, and that's typically the case of health insurance. But the more modern type of insurance, and what we are going to focus on, is insurance through risk pooling. That's typically what happens when you buy an insurance for your car. Okay? It's risk pooling with a contribution, in other words, a premium, which is based on the level of risk you are exposed to. If you have a big car, okay, if you have had accidents in the past, if you drive more than the average, okay, then you will be considered as having a higher risk than others, and you will be charged a higher premium. Okay, so it's the modern insurance. Okay, the type of insurance we are going to focus on is based on risk pooling. You put together a large number of risks so that you can benefit from the law of large numbers, which was also the case in Social Security. Okay, and within the pool, you try to isolate people who are exposed to the same risk. People with the same risk will pay the same type of premium. If you are riskier than others, you may have to pay a higher premium. Okay? Well, and we could say also that now we are entering a new age, which I'm not going to develop right now, but more at the end of this course, the digital age. Why? Because, you know, I was talking of risk pooling, meaning that we put together a group of people assuming they have the same risk. And if they have the same risk, well, in this case, they will be charged the same premium. Okay. But with digitalization, with the use of social media, you know that there is a possibility for people like insurers, for instance, to know everything about you, all the details of your life, and they can identify easily, whereas you are a dangerous person or not. So it tends towards a kind of individualization of pricing in insurance. That's why some people claim that it is the end of insurance in itself, because insurance was based more or less on a concept of solidarity, of at least risk pooling. You put together people who have the same position toward risk. Okay? Now with digital technologies, you can focus and price individually each person. Okay, and then pooling doesn't work anymore in this context, and that's why, you know, some people are questioning whether we are still doing insurance or not. There is no solidarity anymore at all in this type of system. That's why it is really changing. It's not just a technical change, it is a conceptual change of what insurance is all about, and that's why it's a very important point. Okay, so now, what are we going to do? Which type of insurance are we going to look at? Technically, risk pooling with a risk-based contribution. This is exactly what we are going to focus on. When we're going to look at pricing, for instance, we will consider a group of people with exactly the same type of risk. Okay? In this case, how do we price that? Okay? So, now having said that, let's come back to the insurance policy, what it is exactly. The best way to present the use and the aim of insurance is to start with a balance sheet. This could be your personal balance sheet, for instance. It could be the balance sheet of a company, but it should be also your personal balance sheet. If you look at the asset side, you may have physical assets, you may have a car, you may have a house, you may have some furniture, and so on. You may have some financial assets, saving accounts, you may hold shares and bonds, and so on. And intangible assets. What are they? Your know-how. For instance, the fact that soon you're going to have a new degree, which is the MEBF degree. You should look at this degree as an intangible asset. You know why? Because it will have an impact on your future cash flows. Okay, and that's why we are proud to take your money because it's coming to us is not free, But we feel comfortable when taking your money, because when we look at your future, we know that at the end of the course, at the end of the program, you will increase your future cash flows. And since you are in finance, well, you know that an increase in future cash flows means a higher present value of your wealth. Okay? So intangible asset, in this case, at your personal level, has to do with your capacity to generate future cash flows, either by your physical capacity to work, and indeed also it is linked to your level of education, your level of expertise, and your capacity to achieve important careers in the future. Okay? Indeed, these assets, you may have borrowed money for that. Okay? That's why you have liabilities. And indeed, your wealth is just a difference between the value of your assets and the value of your liabilities. Okay, and I would say, if I come back to your investment in CSVG with the MEBF, you can look at it as an investment. I would say that it is an investment with a positive net present value, meaning that the increase in your intangible asset would be higher than the cash you have used, or maybe the debt you had taken to finance your program. Okay, so what about insurance now? Insurance is there to protect your wealth. Why? Because due to the occurrence of an event, a particular event that would, you might have a negative impact on your physical assets. Your car might be destroyed, for instance, your furniture might be stolen, and so on. Your financial asset may also be at risk, if you have shares, for instance, and your intangible can also be at risk. For instance, if you have an accident, maybe you will not be able to work and you will not be able to generate an income for your family. Okay? Liabilities. What about liabilities? Let's imagine you have an accident with your car and you are responsible for that. You may have to pay compensation to victims. So you see, you have potential liabilities which are due to the fact that you might be responsible for something happening to someone else. And if you are responsible, you may have to pay fines or compensations. Okay, so insurance is there. Okay, wealth is at risk because of possible occurrence of adverse events, which may affect your assets negatively and or your liabilities positively. Okay, and so you can see what we call property and casualty insurance. These are policies which are designed to protect your physical asset in case of the occurrence of an adverse event affecting negatively your financial assets. When it comes to financial assets, well, it's not so much the field of insurance, but you have heard of hedging instruments. Okay, you can use options, all types of derivatives, swaps and forwards and so on to cover your assets. And that's why, you know, these hedging instruments can very much be seen and treated as insurance, kind of insurance instruments, okay? But they are not indeed sold by insurance companies, but, you know, it's very similar to. What about intangible assets? They have to be protected, and it's a field of insurance which we call personal protection. It's protection against what? Any type of adverse event that would interrupt your capacity to generate revenues for your family or for yourself. Okay? Or it could be true also for a company. A business interruption, for instance, due to an accident, would have an impact on future cash flows and the intangible. Or, for instance, for a company, you know, there are some events that might jeopardize the reputation of the company. And as you know, the reputation is a very important intangible asset today for many companies. And that can be protected also. The reputational risk is a very big risk today. So this is the field of personal protection. And if you look at an individual rather than a company, it can be a protection in case of death of one of the members of the family. Okay, that's strictly life insurance. Disability, in which case you may not be able to work, to continue working, and therefore there is an interruption in your revenue flow. Health is also an issue. Okay, unemployment can be seen as a kind of economic accident. Okay, which also can be seen as an adverse event interrupting your capacity to generate future cash flows. And when it comes to the other side of the balance sheet, you have liability insurance, which is there to protect you in case you are responsible for an accident with victims claiming compensation, and therefore liability insurance can be there to pay for your compensation. Okay, so you see, using this approach, you clearly understand the nature of an insurance policy. An insurance policy is a joint asset. You understand now the meaning. Property and casualty insurance policies are joint to your physical assets, and they are there to protect your physical assets. Personal protection can be seen as a joint, the policy in this domain can be seen as a joint asset joint to your intangible assets. Okay? It's the same for liabilities. And that's why I'm using this expression. The insurance policy is a contingent joint asset. Joint asset. I assume that you have understood why I say that. Because you see that each policy is attached to one component of your balance sheet. Okay? But it is also contingent. Why? Because an insurance policy in itself has no value. Okay? And that's the reason why, from an accounting point of view, you know that an insurance policy is not recorded as an asset in the balance sheet of a company. But if an accident occurs, and if you are insured for this accident, then all of a sudden, the insurance policy has a value because it is a promise from the insurer to compensate for your losses. In other words, as soon as the accident has occurred, the accident as stipulated in the policy, as soon as it has occurred, it triggers a payment from the insurer. And that's why we use the word contingent. Contingent means that the value of the insurance policy is appearing the day a particular event occurs. And that's the meaning of this word contingent. Okay? Policyholders pay a premium to obtain the guarantee of a financial contribution from the insurer would an accident occur. So the value of the insurance policy is triggered by the occurrence of the accident or the adverse event covered. Okay? And that's why we use the word contingent. So, having said that now, let's go a bit deeper in the analysis of an insurance policy. What do you find in an insurance policy? What are the different items on the contract? First of all, we said that an insurance policy is there to cover the consequences of an adverse event. The first question is, which event is or are covered? What is the source of the risk? Then the very first thing you will see on an insurance policy is a list of all the events which are either insured or non-insured. Okay? To make sure that there is a clear definition of what is the scope of the insurance. Okay? Not only we stipulate in the policy the events, but also a geographical scope. You may have an insurance for, let's say, your car if you drive in the region of Ho Chi Minh or Hanoi. And I don't know how it works in Vietnam, but depending on the region where you are located, you may be considered as a different risk. You know, that's typically the case in France, for instance. If you drive a car, if you are in the region of Paris with a lot of traffic, well, insurers know that there are more accidents there in comparison with other regions in France where the traffic is much lighter. Okay, and you could have difference in premiums paid depending on the region. That's why you usually also have not only the reference to a particular adverse event, for instance, an accident with your car, but there is also a geographical scope which can be also defined. And indeed, usually the insurance is for a period of time, in most cases 1 year, okay, which is also stipulated. So, were they even insured? Which geographical scope and for which period? Okay, having said that now, the next question is if the event occurs. Well, what we are interested in are the consequences. What are the adverse consequences? So the contract, the policy, will also specify the type of damages which are insured or not insured. Okay? To take an example, if you have a car, you have a motor insurance, you may have a fine because you are not driving properly. The fine, hey, the risk of getting a fine is an adverse event. Don't expect to get coverage for that. Why? For a basic reason which we are going to develop later on. Just because, you know, would you be insured? You would say, well, I don't mind to drive in a dangerous way because I know that if I'm sanctioned, then the insurer would pay for that. You can easily imagine that this would not be possible. So these type of things are excluded. Okay, so you are not going to be compensated for anything. If, for instance, you have an insurance policy in case you would have someone coming in your house and stealing all types of things and so on, well, the insurance might impose that, for instance, you have no cash money in your house. If you say, well, I was stolen a computer, my TV set, a nice piece of furniture, okay, the jewelry of my wife, well, this could be damages which would be compensated for. But if you add, well, and also I had $10,000 on my desk, well, the insurer will not pay for that. It will be excluded. Okay, this is not the type of damage that the insurer can really reasonably include in the policy. Why? Because you say 10,000. How can you verify that? Why not 20,000? Why not 30,000? You see, it's just not feasible. Okay, so you see, the damages which you insure will be listed clearly. Well, then, okay, we have the list of the damages that will be taken into account. Now we need to know the size of the loss. Okay, what is the amount of money? Okay, your house has been destroyed. Okay, or let's say you have an accident and your car has been destroyed. What is the amount of money you are going to receive? Indeed, I hope you don't expect to be compensated with a new car if you had a 10-year-old car. Okay, so the principle, and it's part of the insurance law, is that the size of the loss which will be considered by the insurer refers to what we call the replacement cost. In other words, the idea is very simple. How much do you need to replace what has been destroyed? Okay, it's fair enough to base the compensation on that. Okay, so if you take the example of a car, it's rather simple because you have a used market for cars. So if you have a car which you bought 3 years ago with, let's say, 30,000 kilometers already, well, you can find on the used market a reference to give you the price of such a used car. And this will be the basis for the compensation. Okay. So it looks rather simple, but it looks rather simple in my example because there is a used market. Now, let's assume that you have a house. There is a storm and the roof is destroyed. Okay. You think that the insurer will pay for a new roof because you cannot replace your roof with an old roof. Okay. It has to be new. The problem is that the insurer may not accept to pay for a new roof. Why? Because if your roof was 20 years old, it was an old one, and it should have been repaired maybe already. Okay? So the insurer will inevitably take into consideration a kind of depreciation of your roof. In other words, taking the value of a new roof and saying, yes, but since you had it over 20 years. Okay, and if you consider that the roof should last 30 years, it means that the insurer may compensate you with only 1/3 of the price of a new roof. Okay, so you may not be happy with it, but you have to understand that, there is no reason why the insurers should give you more than the net value of your asset. Okay, because in this case you would receive something with a value which is higher than the value of what has been destroyed. It is particularly an issue for companies, for instance, if they have a piece of equipment which is unique and they cannot buy a used one. They have to replace with a new one, okay? And they may not have the cash to do so. In this case, the insurer may accept, and it will be a very specific point in the policy, saying that he would accept to pay for a new one, but usually, indeed, that would cost much more in terms of premium, and usually the insurer will also impose what we call a deductible to the policyholder. A deductible, as we'll see, is an amount of money which in any case you will have to pay for. Okay, in other words, you share the loss to a certain extent with the insurer to make sure that the policyholder will be careful and will make sure that the accident does not occur, because even if he is compensated at the full price of a new equipment, at least there is still part of the loss, which is the amount of the deductible. Okay? Well, there are other situations where it may not be easy to value the replacement cost, because sometimes things cannot be replaced. If you have, for instance, a unique painting, okay, a unique painting from Phi, for instance, a famous Vietnamese painter, which would be worth, let's say, $10,000, okay, which is a reasonable price for a painting by Phi, okay. Well, if this painting is destroyed because of a fire, for instance, in your house, well, you for sure you cannot replace it, okay. So what do? Well, in this case, you have to agree on the price of the painting beforehand with the insurer. You may have your own, let's say, a specialist indicating a value. The insurer will also have his own specialist, and they would agree on a value. So it would be an agreed lump sum, which will be indicated in the contract in case of destruction of this type of asset. Okay, so keep in mind the basic principle, which is an important point: replacement cost. And you can imagine also, just let's here make a brief comment. It's easy now to understand the difficulties sometimes between insurers and policyholders. I know that many people would consider that insurers are not fair people. They never want to pay and so on. Well, the ambiguity comes from the fact that the insurer has to be very precise in the writing of the policy. Because, each time an insurer is selling a policy, the insurer is taking a risk also. And the value of this risk has to be indicated in its balance sheet. And regulators are very strict with that. And they verify regularly that insurers have a proper accounting for the risk they take. So insurers are very precise, have to be very precise in the definition of the risk they take. That's why sometimes they are strict in the writing of their policies with all type of details that buyers sometimes have difficulties to understand. Okay, and each time they realize that their policy is not covering their loss, they are usually not happy because they were not aware of exactly the scope of their insurance policy. Well, so now we agree on the size of the loss. We agree on the damages which have to be taken into account, and the event that has occurred corresponds to what was specified in the policy. So now, what will be the amount of money paid by the insurer? Well, it will be the replacement cost, as we said, as it can be measured, okay? But we have to take also into account deductibles. Remember what I said about deductibles? If you have, for instance, a deductible of $1,000, okay? And if you break your cars and the replacement cost of your cars would be, let's say, $10,000. If you have a deductible of $1,000, it means that the insurer would pay only $9,000 and your loss would be $1,000. In other words, it's a way to share the loss. Why are there deductibles? To avoid what we call moral hazards. I'm probably not the first one to mention this concept of moral hazard. It's a major problem in banking also. But, insurers want also to make sure that insurance will not be, let's say, would not lead to dangerous behaviors. Some people with a large insurance coverage might say, well, I don't need to take care. I don't need to be careful. I don't need to, to spend money on prevention and so on, because I have an insurance in any case. So insurers don't like it because it means that once they have sold insurance, the risk is higher because people don't care anymore. Okay. So one way to associate the policyholders to the non-occurrence of the event, of the accidents, is, for instance, to have a deductible, so that the policyholder keep in mind that there is part of the loss that will be for him. Okay, so compensation taking account deductible and also possible sanctions for non-compliance with contractual obligations. Let me give you an example. If you take the case of fire insurance for, let's say, a retail outlet, okay? Usually, you have in this type of outlets, you have what we call sprinklers. I don't know if you all know what sprinklers are. It's a very efficient prevention system against fire. It's a kind of shower that is just putting water exactly where the fire is starting. If you look at it, if you go in a retail in a store, look at the ceiling, you will see these type of things, and you can use your lighter. You will see what happened. Well, just don't tell after that I told you to do so. Okay, then you will see how it works. So it's very efficient. Okay, and this prevention system is not so expensive. So it's really a good thing to have. Okay, and because it is very efficient, it means that the probability of a severe fire is very low. Okay, and that's why insurers would accept to have a much lower premiums, because it's much safer than a risk without this type of protection. Okay, so you pay a low premium if you have sprinklers. Now, let's assume that you have an accident, a fire, and it all destroyed. Why? Because the sprinklers didn't work. Why? Because they were not maintained in good conditions. Whereas you had the obligation to maintain your prevention system in good condition. In this case, the insurer will not pay for it. They might pay, but less than what would have been normally paid. Okay, so this is an example of a non-compliance with a contractual obligation that would lead to a lower compensation. Indeed, no need to say that when this occurs, policyholders are not happy with it. Even though when they signed the contract, they accepted the idea that they would pay a lower premium because of the safety they have in place. Well, finally, you also have obligation of parties. We've talked about it. That's typically in the case of prevention, legal aspect, and so on. You have to comply with the rules. If you drive and if you are drunk when you have an accident, then you may have difficulties because the insurer will compensate the victims, but then the insurer will come back to you for you to pay because you didn't comply with the law, which says that you should be drunk when you drive. Okay. And finally, you indeed have the premium, the amount you have to pay, which with commercial and pure premium, which are two concepts which I'm going to develop later on. Okay, so these are the contents of the insurance policy. All these items are the what you find typically in an insurance contract. Event, the type of damage to be compensated, an evaluation of the size of the loss, how to determine the compensation after that to be paid, with the obligation of parties and the amount to be paid. the premium. Okay, so let's look at the a very simple case to show you how difficult it is sometimes to see how the policy will apply when an adverse event occurs. So here I'm considering the case of an explosion occurring in a company outlet. Due to an explosion followed by a fire, part of the facilities of the company have been destroyed. Okay? Not only the building has suffered damages, also the equipment and goods ready for sale have been destroyed. It should cost about $100,000 to repair the building, and it may take up to 6 months to restart the activity. The equipment destroyed was acquired 3 years ago for $340,000, and the inventory lost had a book value of $24,000. Hopefully, the company has purchased a fire insurance policy. And my question is, do you think it will cover all losses incurred? So let's look at this example, which basically doesn't look as very complex. Okay? First of all, what has occurred? The first element in the policy is the event. Due to an explosion followed by a fire. The explosion has caused a fire. You have to know, for instance, that the explosion and the fire are two events. If you have only a fire policy, it may not cover the case of an explosion. Indeed, in this case, the company will not be happy with the insurer. At least because the insurer should have explained to him that due to its activities, there was an explosion risk. And that in this case, due to this higher risk, due to the possibility of an explosion, okay, then he should take an extension of the insurance for explosion, okay? But if this has not been done, then the policy would not apply, okay? So here, that's the first point. So let's assume the explosion was part of the policy. These two events were covered. So now let's look at what are the damages. You have the building, okay? You have the equipment, and you have the goods ready for sale, okay? But you also have 6 months without activity, which refers to what we call the business interruption risk. Okay, is it covered? Well, it depends. It depends if attached to the fire event, if you have attached business interruption risk. You know, some companies may not like to take it because they don't need this, because they feel they have enough cash flows running and so on to if they are part of a group, for instance, and they know they will not be short of cash and so on, or they can count on their banks to provide the cash flow they need during the interruption period. Some people may not need to have it, but you know, for some small companies, it's very useful. But this needs to be stipulated. If it was not stipulated in the policy, well, the business interruption would not be compensated for. It means that they would not have any coverage for the loss of cash flows due to the business interruption. Okay, so now, having said that, we see concerning the events, concerning the damages. Now the question will be, what about the evaluation? You see, what about the building? The building, it would cost about $100,000 to repair it. Okay, so this $100,000 amount should be compared with the net value of the building. If the net value of the building in the balance sheet, for instance, after depreciation is only $50,000, then the insurer may not accept to pay $100,000. He would say $50,000 is enough because it's a replacement cost. I will not pay for more than the net value, the net book value of the building. And in this case, the compensation would only be $50,000. Okay. What about the goods ready for sale? Okay, that's inventory. That's a very specific problem in insurance, because you know that inventory may fluctuate over the year, months after months. Okay, if the accident occurs at a period where you have a full level of inventory, where you may have a huge loss, whereas if it occurs a month when the inventory is very light, well, it's a very small loss. Okay, so this is tricky. So it depends on what has been declared to the insurer in terms of amounts on amounts of inventory insured. You know, usually you would take an average, but if the amount that was declared was too low, that it may happen that the insurer may not accept to pay for the full amount of the inventory destroyed. Well, when it comes to the equipment destroyed, which was acquired 3 years ago for this, you have to look at the value. You have to look at the value after depreciation, okay? And indeed, the insurer would not normally pay more than the net value after depreciation, okay? And when it comes to the business interruption risk, again, I'm not going to give you all the details here, but when you have such an insurance, if among the event, on the list of the events, you have the business interruption, which is included, well, there are also details on how the losses will be measured, okay? So you see this rather simple example, which is it's a very common type of accident. I just wanted to show you that, you know, it's always rather complex, you know, and I repeat, one of the difficulty for insurers is that each time they take a risk, as I said already, they have to value it to indicate the value of this risk in their liability, in their balance sheet, okay? But to have an evaluation process that makes sense, well, they need to be precise in the definition of their policy, to be precise with the definition of the events, with the definition of the damages they are going to pay for, with the definition of how they are going to measure the losses, okay? And by being precise, and it's a technical necessity for them, it creates a kind of difficulty for them when their customers are not able to understand the details of the policy. That's why the insurance intermediaries have such an important role. And one problem, and it's particularly true in a country like yours, the weakness of the distribution system is a major obstacle to the development of insurance, because an insurance policy is necessarily complex. So you need someone to explain the complexity to buyers, to policyholders who may not have the capacity to understand precisely what they are buying. Okay? Well, so just to conclude on the insurance policy, let's have a quick financial perspective, and then after that, I will propose a short break, because otherwise you will collapse. Okay? So just to show you also that an insurance company policy is very much like a contingent asset, like a derivative to a certain extent. Since it is joined to an asset, it can be seen as a derivative, okay? And you can compare an insurance policy to a put option. You are probably familiar with this graph because you had courses where options were presented. So you have the value of the underlying asset, the insured asset, okay? And on the vertical axis, you will measure losses down and the gain up. And the exercise price of the option would correspond to what I call the insurance value. That is, for instance, if you have a car, let's say that the insurance value would be the value of your car on the market right now, let's say 20,000 euros. Okay? Well, if you own the car without insurance, you see, if the value goes up on the right side, well, you have a gain. If it goes down, you have a loss. Okay? What is an insurance policy? First of all, you pay a premium. The premium can be compared to the option price. And if you have an insurance policy, what is the guarantee you have? The guarantee is that if you have a loss, for instance, if you have an accident with your car, okay, the value of your car will decrease, okay, due to the fact that the car is more or less broken. Okay, and actually, if you have an insurance, the insurer will exactly pay a compensation which cover the size of the loss. So in other words, the compensation is represented there with the red line, which is a perfect compensation which cancel out the loss. Okay? Indeed, this option cannot be exercised in any case. It's only if the accident was occurs is part of the events which were specified in the policy. Okay? So you see, if you now consider someone owning a car and together with it a joint insurance policy, then the net position would be this one, which shows the type of coverage you have, okay, which is similar to, for instance, the scheme you have when you have a share with a put option on this share. Okay, you have a protection in case the value decrease because you have your right. If you have a car, if you have a broken car, the insurance provides you with the possibility to sell your broken car to the insurer at the policy price, at the insurance value. Okay, so you can really compare. An insurance policy to a put option. Let's look at the situation now where you would have a deductible. If you have a deductible, it means that part of the loss you keep it for you. Okay, so the compensation starts later once you have taken out the deductible. Because of this, you will pay a reduced premium. So you have different types of coverage, which would be like this. Okay, that would be an insurance with a deductible. Okay, so I just wanted to have this slide just to really make sure that you have clearly understood that an insurance policy is a financial asset. Okay, and this financial asset is issued by insurers, okay, and invested in by policyholders. So it shows clearly the financial dimension of the insurance business. And that's why I thought that this presentation, even though it's a bit theoretical, okay, this presentation is nevertheless useful from a pedagogical point of view. So as I mentioned here, deductibles are frequently imposed to avoid moral hazard, okay, but also to avoid large admin costs. For instance, because with your cars, you may have a lot of accidents, hopefully are not severe, and you may have just a few things to do in your car with a bit of money to spend. But an accident that would cost $100 to the insurer, or that would cost $30,000, in terms of admin cost, treating this event would be the same price. And small accidents, hopefully, are much more frequent than severe accidents. So deductible is also a way to avoid huge admin costs because of frequent small claims. And it is beneficial to insurers, but also to policyholders, because it makes the whole system more efficient. Okay, so now the next step. I hope at this stage that you have roughly understand what insurance was all about and the structure of an insurance policy, okay, with the idea that an insurance policy can be seen as a kind of derivative, a joint asset attached to one element of the wealth of the economic agent. Okay, so now I said in my introduction also that insurance is becoming more and more important, particularly in a country like yours. That's the next step in my introduction. But I'm looking at my watch, and I think it's reasonable to have a 15-minute breaks. Okay, I'm pretty sure you would agree with that. Are you okay with that? Okay. Voilà. Okay, I am back. Okay, then let's go ahead with this slide. Okay, so the growing insurance demand in a complex and uncertain world. Well, let's look at it. What are the reasons, the main reason why you have such a growing demand for insurance? Well, first of all, an increasing social demand for security. This is particularly true in mature countries where, we consider that we have to be protected against everything. The liability system is becoming stricter and stricter, so there is a huge need for insurance to make sure that victims, in any case, will be compensated for. And the only way to guarantee this is to have a proper, efficient insurance system. By the way, let me take an example in motor insurance, which is relevant to a country like yours. Maybe you don't know why motor insurance in many countries became compulsory. It's just because it was the only way to guarantee the compensation of victims. If you drive your car, if you are not insured, if you have an accident and if you create damages to others, okay, they will be victims. Normally, you should pay for a compensation to the victims because you are responsible. But you may not be able to afford that, okay? The only way we can make sure that victims will be compensated is to go through the insurance system. If you have an insurance, okay, even if the compensation to the victim is a huge amount of funds you may not have in your pocket, if you have an insurance, well, the insurance will pay for you. Okay, so you see, insurance, for instance, is a way, a kind of technique to guarantee the compensation of victims and therefore the development of a proper liability system. Well, so increasing social demand for security, I told you it's particularly true in mature countries where we already have a comfortable life and we want always more in terms of protection and comfort, if I may say. But make sure that this will occur also in your country. The legal trend, which follows what I'm saying, the legal trend is also, to a certain extent, an issue for insurer because now you have so many lawyers all over the world that they would sue anyone for anything. Okay, as I will show you with some numbers later on, this trend is really driven by the Anglo-Saxon countries. And I heard recently, though I need to verify this number, but anyway, I think it's to a certain extent it is exact that you have about half of the lawyers all over the world who are in the US, and this is really where all these trends come from. Aging concerns particularly life insurance. I will give you a few numbers here also. And Vietnam is concerned. The Asian region is very much concerned with that. Aging means that you will have a growing number of retirees as a proportion of the total population. And behind that, you have a pension issue. You have a healthcare issue, and so on. And indeed, the life insurance system in particular has something to do there. Well, climate change, cannot be ignored today. When you look at all the casualties that it may create, indeed, the insurers are very much concerned with that, and they try to work hard on that to find solutions, but it's not easy. We'll say a few words on that later. Well, if you look at more particularly to the business risk, well, it's a source of worry also. Due to what? Increasing competition. The world is tough as far as competition is concerned now for companies. Okay, and in a context of tough competition, companies try to do their best. They try to do fast, to be first on the market, and by doing so, they tend to take more risk. Okay, and by taking more risk, their risk exposure is higher. They have less control on their environment because of this competition, and indeed, to front this increasing risk exposure, well, insurance can be useful. A technological trend, new technologies generate new risk. Anyway, there is an important remark to be made there. All the technological progress which we have observed over the last decades would not have been possible without insurance. Okay? Without guarantees one way or another, some technologies would not exist. Okay? Take an aircraft, for instance. It's a very useful technology if you want to travel, but it's also, to a certain extent, seen as dangerous. There is a strong demand for security when you travel. And the consequences are so dramatic that you have an accident, and you need to have an insurance system to make sure that victims will be compensated and that the money will be there. So without insurance, you wouldn't have airline companies. Okay, you have to know, for instance, that without a proper insurance policy, insurance cover, an aircraft cannot take off from all international, I should say, airports. Well, talking about a technology trend, I just want to add one particular issue today, which is part of that, which is what we call the cyber risk. You all have heard of that. It's a major risk today for companies. Here again, insurance are doing a lot to try to find solutions. They will not be fully satisfactory because due to the importance and the specificity of the cyber risk, it's very difficult to design insurance policies that would provide a full coverage, but nevertheless, insurers are doing their best to try to find solutions. Concentration is also an issue. Concentration means that you have large entities rather than scattered small entities. When you have scattered small entities, when you have an adverse event, usually it would impact a small entity, whereas if you have a very severe accident with a large scale facility, well, indeed, the size of the losses is much higher. Well, globalization, and together with it, you can talk about geopolitical risk, terrorism, and all these things that goes together. And indeed, this is also a source of complexity and risk for companies, where also insurance companies are trying to play a role and to contribute to the provision of solutions for companies. So you see, for all these reasons, it's easy to understand why insurance is becoming more and more important today in our complex world. Well, I've also on the list added excessive debt financing. Why? Probably you talk about this with my colleagues. You are familiar with the concept of financial leverage, and you know why companies take debt. Because if they borrow at 5% and if they invest their money in a 10% project with a return of 10%, well, you see that you have a kind of spread of 5% that contribute to increase the return on equity, okay, which is typically what we call the financial leverage. But you know that the financial leverage increases also the risk. Okay, that's one point. But the other point is that apart from this financial leverage and the impact on the return on equity, you also have another reason why companies have a lot of debt. It's just because shareholders want to put a pressure on managers. You know, if there is no debt, it means that the cash flows will be higher because you don't have a debt service, and the managers will feel comfortable with using these large cash flows to, let's say, launch projects which are more in line with their own objectives rather than being in line with the objectives of shareholders. So it is well known today that a certain amount of debt in a company is a way to put a pressure on managers to oblige them to be efficient and to use efficiently the cash flows that remain with the company. Okay, but by doing so, it has also contributed to sometimes excessive risk-taking in companies. And this also has contributed to increase the risk exposure of companies, hence also the need for insurance in case. Well, probably there are many other points which we could mention to explain and to show the increasing risk exposure of economic agents, but I think that this list is already enough to convince you of the growing importance of insurance. Well, so if you want to summarize the situation with a graph, you know, here you have what we call the risk pyramid, okay, which is a description of the risk exposure of economic agents. Well, it's represented with, well, it's more a triangle than a pyramid. On the horizontal axis, you measure the frequency of the risk and the severity of the risk on the vertical axis. So this graph just represents a very simple idea that hopefully very severe accidents at the top of the triangle, at the top of the pyramid, hopefully are less frequent than, let's say, light risk, you know. So that's a way we can represent generally the risk exposure of any economic agent. Well, what is the evolution today? The evolution could be described by this change, with a triangle which is narrower at its bases, but with a higher peak. Okay? Why is it narrower at the bottom? Just because we have done a lot in terms of safety standards, okay, and prevention, so that for regular risk, I would say, recurring risk, let's look at the motor insurance risk, for instance. You know, the safety on board has increased dramatically. Also, the regulation concerning driving and so on has also been adjusted to make sure that there are speed limit, all type of traffic lights and so on to avoid collisions and so on. And you see, we have been able to reduce the, let's say, current risk, which are more or less severe, but not too severe. But what we have to cope with today is a trend towards, in which is due to the higher complexity, particularly the technological complexity today. The use of non-proven technologies, as we call it. Climate change is also a factor, you know, which has contributed to increase the prospect of catastrophic events. Okay, so we have done a lot in terms of current recurring risk, for which prevention systems have been developed, and safety techniques, and the behavior of people has changed also. Regulation has also helped a lot. But, you know, if you look around, you see, we observe more and more catastrophic events. Okay, and that's a problem, and that, as we'll see later on, is a major challenge for insurers, and that's why there is a need for new solutions, okay, which we will see particularly when it comes to reinsurance activities. Okay, so I was talking about catastrophes. So you have, sorry, excuse me, you have it on a graph here, which gives you some idea about the frequency of catastrophe. The catastrophe, well, these data come from Swiss Re Institute, which is a research entity of Swiss Re. Swiss Re is one of the biggest reinsurance companies located in Switzerland, as you can imagine. Okay, you have the website, which is indicated there, and I really recommend, if you have any questions concerning the insurance business, you know, I really recommend you to go on this website, because you will find answers or explanations concerning a wide range of insurance issues. Okay, so here, this is an annual publication which provides data about the occurrence of disasters or catastrophe, if you like. Well, you have the definition of what is considered a disaster or a catastrophe. An event is included in the sigma statistics if insured claims, total economic losses, or the number of casualties exceed a certain threshold. In other words, they have defined a threshold. I don't give you the detail of that, but if you can, if you absolutely want to know about it, you just go on the website here and you will have more detail on that. So here you see there is a distinction which is made between two types of disasters, what we call man-made disasters, the blue column, and natural catastrophe, which is the dark blue line. Okay. As you can see, if you look at the evolution between 1970 and 2005, which is the period of the globalization trend, by the way. You know, globalization started really in the mid-80s, okay? And you see a dramatic increase starting in the mid-80s, let's take 1985 as a starting point, up to 2005, you see a dramatic increase in the number of catastrophes. And that is explained by several of the factors which I have mentioned before. Non-proven technologies, globalizations with companies operating in very uncertain environments with different cultures and so on, with difficulties to organize the company, with a lack of coordination, information, and so on, which indeed leads to inefficiencies and sometimes very severe incidents. Okay. Hopefully, after a while, after 2005, it may be also the consequences of the very severe crisis that occurred in 2008. You see that the number of these catastrophes have decreased, which is due to the fact also that corporations have made huge efforts in prevention to limit the occurrence of catastrophes, which became a real problem in the late 2000s. Okay. Nevertheless, if you look at the natural catastrophe, you see that the trend is not decreasing. You don't have a turn. Okay, it's always increasing, and we call that natural catastrophe. But you know, some people would argue that it should be considered as part of man-made disasters if you agree with the fact that the climate change is, to a certain extent at least, the result of human action. Okay, so you see, there is a challenge there, and it illustrates rather well the representation which we had before on the slide before with the risk pyramid. So the challenge of the increasing frequency of severe catastrophe. Well, I made a few comments about the liability risk, which is also a concern. Here you have an interesting graph that shows the importance of the liability risk depending on the region where you are. Okay, here you have the liability cost as a percent of GDP. Okay, and as I mentioned here, you can see that Anglo-Saxon takes the lead. You see, if you look at the United States, for instance, you have a figure as high as 166%, which is a liability cost for companies. Okay, the liability cost would particularly include litigation cost. Okay, the cost of lawyers, if you like. And you see that it represents 166 in the US, whereas if you take the Eurozone, it's around 0.6. In other words, in Europe, on average, if you look at France, Belgium, and so on, well, it would be something like 1/3 of what you have in the US. And when you look at the leading country as far as this is concerned, you have US, Canada, United Kingdom, and Ireland, and which corresponds more or less to what we might call the Anglo-Saxon group. Okay, so and that's a problem indeed for companies, and not only for companies, by the way. Okay, which a huge need of insurance indeed, because the legal cost incurred when you have a case to deal with, if you are considered as potentially responsible, you may have to pay huge amount of money to pay lawyers and so on, and their insurance also have a role to play. Okay, but it's also a concern for insurers because there is a kind of moral hazard issue here, because as soon as you have insurers ready to pay, well, lawyers tend to be very generous with victims because they know that in any case, insurers will pay, and therefore their customers will be happy, and they would charge higher fees. So there is a kind of moral hazard issue there, which is a concern for insurers. Well, I mentioned also aging as an issue. Okay. Here you have a curve, which is interesting also. It's a graph which it was published in the United Nations report, okay, by the Department of Economic and Social Affairs. These were numbers for 2019, okay, latest figures we can find now. And you have some projections. You see, what you have here is the working age persons relative to the number of older persons in the population, okay? If you take the figure for 2020, for instance, for Europe and Northern America, the lowest curve, you have a figure which is about 3, which means that you have 3 persons working for 3 old persons, let's say retired person in the population. Okay? And as you can see, for all of these curves, for all countries, including your regions, you have a decrease of this number. What does it mean? It means that because of the aging trend, on average, the proportion of old people will increase. Okay? If you look at the Europe and Northern America, which includes most of what we call mature countries, just excluding Japan here, you see the value is 3 today. If you look at, let's say, 2050, it will be around 2. In other words, whereas we have 3 people at work today for 1 retiree, we're going to have only 2 people at work for 1 retiree, let's say, in 2050. So who will pay for the pensions? I'll come back to this discussion because it's a hot issue in most countries, how to reorganize the pension schemes and what might be the role of life insurance companies in this play. Okay, I will look more precisely at the case of Vietnam later on. But if you look at the region that concerns, which is the blue line, you see the blue line which is there, dark blue, you see that it's around 5 in 2020, and it's going to drop in 2050 to the same level as Europe and Northern America, which means that in 2050, as far as the ratio of working people over the retiree is concerned, will be roughly the same in your region and in our region. When I say in your region, to be fair, I have to indicate that this would include Japan, which is a country where aging is a key point. Okay, it was just to give you some elements following the argumentation which I've presented before to explain that insurance was gaining in importance. That's indeed the aging trend mostly concerns life insurance and pension issues. What about pension funding? That's the question. Well, now the next step is that you should look at insurance growing as a positive point because it's part of the economic development. Okay, so let's consider this. So economic development, first of all, has a positive impact on insurance. Why? Because together with positive, it's a kind of a virtuous circle. Economic development has a positive impact on insurance. Okay, and insurance development has a positive impact on economic development. So you have a curve, a circle here, which is a virtuous circle. Why is economic development favoring the insurance development? Because protection becomes a growing social need. The more you have to protect. Okay, so this is well observed. Together with GDP growth, you observe a more rapid growth of insurance business. Well, changing the organization of the society, you have a trend, a movement from more, let's say, from formal insurance schemes where the group to which you belong is important, so that's where you find your security, to a more individual kind of system. Together with individualism, you see the growth of insurance, because insurance is the solution if you cannot count on a group, or if you think it is better to use insurance rather than counting on your family, for instance, in case something happens. Rather than sharing the burden, you say, well, why should I share the burden? Insurance is the right way to go for. Okay? So the fact that people become more independent, okay, not necessarily cutting the link with the group they belong to, but they tend to become more independent, and by doing so, they look at individual type of solutions for their coverage, and that's the role of insurance. And also, together with economic development, people tend to have a long-term perspective. If you take the extreme case of a very poor country, in such a country, people just think of what about tomorrow? Maybe just what about next lunch? Okay? So in this case, well, insurance is of no need. You have no guarantee, you have nothing. If you have nothing at risk to a certain extent. Okay? Well, when you start accumulating wealth, if you have a good job, your family is happy, okay, because you bring back money at home. Yeah, so what if you have a health problem, if you cannot work anymore, if you cannot provide the money? Well, you have a long-term view. You want your kids to be educated, you have the projects to buy your house, and so on, and all that falls down. So when you have this long-term perspective, you try to protect yourself to guarantee the achievement of your objective in the future. And the only way you can do that is through insurance, and in particular through life insurance, which includes guarantee for the long term. Okay, so that's the first step. Economic development generates an additional demand for insurance. Now, the insurance development will have an impact on economic development. Why? Because together with insurance, you have an increased economic rationality and efficiency. Through the insurance system, you have a proper assessment of risk. And with a more serious assessment of risk, you improve the quality of the decision process. The selection of projects, for instance, will be based on a serious risk analysis, where you will see what is feasible, what is not feasible, what is acceptable, what is not. So you have a higher economic rationality and efficiency. You have an improved prevention technology. Why? Because insurers are very much concerned with prevention. They like to have good customers. They like to have safe policyholders with no accident. That's where they make money. So if you buy an insurance for your car, for instance, they will be very much interested in the prevention or the safety level of your car, because they know that this improvement in safety will be beneficial to them with lower cost of claims. Okay? So by doing so, they can reduce their premium, indeed, and you will benefit as policyholders, but they will also stabilize their business and also have a more efficient system in place and make more money also, by the way. Effectiveness of liability laws. That's also a point which I mentioned before. when I was explaining to you that motor insurance was compulsory to make sure that victims would be compensated. In other words, if you want to develop a liability system which goes together with economic development, okay? Well, the liability system can work. In other words, victims can be compensated only if you have insurance. Otherwise, those who are responsible may not be able to afford the payment they have to make to victims. So the only way you can guarantee that in a society is through the establishment of an insurance system. Another point, which is a very important one, the development of a domestic financial market. As we'll see later on, insurance, life and non-life, accumulate huge amount of money. And that's why this course is also important to you, because some of you are probably interested in what's going on financial markets, capital markets. You should know that the biggest institutional investors, the big players as far as investment is concerned, investment funds, these are insurers and pension funds. Okay? And they contribute, they have a major role in economic development because through their investment, they can favor the financing of all the projects which are needed in countries like yours typically, to finance projects which are long-term projects with the need of huge amount of funds to finance them, and pension funds and the insurance systems together can accumulate enough money that would contribute to that. Well, last point, which is a complement to the previous one, the insurance development would also allow an extension of the lending capacity. For instance, if you are a small-sized company, if you go to a bank, if you want to borrow money to buy a new equipment, well, the banks might be reluctant because, for instance, the bank might say, well, but what if you have a business interruption, if you have an accident with your equipment? Even if your equipment is insured, well, it will be replaced, but if you have a business interruption of 6 months, well, you will go bankrupt. Well, except if you buy a business interruption policy. With a business interruption policy, it will guarantee, for instance, that you will have a compensation for the missing cash flows. Okay? And that would be a guarantee which will be taken into account by the bank to accept to lend you. In other words, by providing more guarantees to the bank, the insurance will contribute to an extension of your lending capacity. And by doing so, indeed, will contribute to the capacity of companies within the country or even individuals to finance projects that will contribute to a further economic development. Okay? So you see, this is a virtuous circle. Now, does it work systematically? Not necessarily. Why? Because you may have negative influences. The negative influence, and you have it in the early phase of the development process of countries, a lack of risk awareness. People would consider that, well, there is no way you can change what's going to happen in the future. You know, it's fate. As long as you have a dominant culture of that kind, it's very difficult to promote insurance because people just consider it's not necessary because there is nothing you can do against what the future will be. Okay? You also have the risk of opportunistic attitudes. People can see insurance as a way to make money. You know, I always remember, I like to mention the case of a student in my class long ago. I was teaching an insurance course already, and he came to me and asked me, well, you know, I have a car. Let's assume that my car is stolen, and I have an insurance for that. In this case, I would receive a compensation for the insurer, he asked. I said, yes, of course, but of course, if you have an insurance policy that covers this case. He said, yes, but now let's assume that it's not stolen, but I tell the insurer it is stolen, and I just sell it to a friend in another country. I told, this is something you shouldn't do. Oh, no, I would never do that, he said. But would I get a compensation from the insurer? So you see, this is a pure example of an opportunistic attitude. The guy was just considering how to make money with the insurance policy by cheating the insurer. The idea was to sell the car in another country where nobody would know, and he would say it was stolen, and then he would get the compensation. It's a pure example, So I told him, don't do that, and it's part of the, it would be unethical, and as you know, ethics is a major issue now in corporate finance. That's why I mentioned this case, and I'm pretty sure that none of you would make this suggestion. But it's a good illustration of what I mean by opportunistic attitudes. As long as you have this, and you still have this type of problem in many emerging countries, okay, that's an issue, okay? And sometimes it's very difficult for insurers to control, okay? You say, I mentioned that in the case of emerging countries, but I spent part of my life in London because I used to be the director of the ESCP London campus. And I had discussions with insurers locally in London, and they'll tell us, car insurance for us is a real challenge. We don't make money with it. We have it because we need to have it, but really we would love to be out of this market. Why? And I told you also that you have a lot of lawyers in London. Well, lawyers, they used to contact people and say, well, if you are an accident of the car, whatever it is, come to me and we'll see how much money we can make from the insurers. You see? And they try to invent and to try to find all type of arguments to get money, even in situations where insurers are not, normally should not pay for it. Okay? Well, that is typically an example also of opportunistic attitudes. That's to show you also that it does not exist only in emerging countries or poor countries where people are not used with insurance and they would see it as an opportunity. But it also exists in developed countries such as UK, Well, lack of expertise and poor image of local insurers. That's a point which I've often heard from people in your country, for instance. They say, well, we cannot count on insurers because, we cannot trust them, okay? We cannot trust them, and in any case, they don't have the expertise to provide us with what we need, okay? So as long as you have this image of local insurers, it is true, it will be difficult to promote insurance and to try to push for the development of insurance system. So what should be done to compensate? You need to have some positive influence at play. One thing to do, and it's an interesting discussion because some people would argue they are against that, insurance market accessible to foreign insurers. The problem is that usually local insurers try to avoid this because they want to keep the market for themselves with a kind of local oligopoly where they make a lot of money, okay? Well, but nevertheless, the contribution of foreign insurers would be in terms of, I would say, know-how transfer. The presence of local insurers, the presence of foreign insurers is a way to introduce best practices in the country, okay, to help local regulators to regulate properly the market, okay? So indeed, it would be competitors for locals. But on the other hand, the locals have a much better understanding of the local market, so they can compete, okay? It is wrong for them to believe that they will not be able to maintain their position on the market because they have a huge advantage, which is of being local. And by being local, they have a much better understanding of the risk locally. And that's why usually when foreign insurers are coming, usually they don't come alone. They can't do business alone on the insurance market. In a country like Vietnam, you cannot do business if you come alone. You need to partner with local companies, okay? And by doing so, usually, you will organize technology transfers which will be beneficial to all, okay? Compulsory insurance is a way also to contribute to a maturation of the market, to launch a strong basis and an experience in a particular domain. And that's the case for motor insurance, for instance. And I explained to you why it did make sense to have a compulsory motor insurance to guarantee the liability system and the compensation of victims. But the compulsory insurance is a way to boost the development of the insurance market. Indeed, you need appropriate regulation. And again, the experience you can grasp from outside, from countries where the insurance market is already developed is useful, but an appropriate regulation is necessary to make sure that local companies behave in a proper way, to make sure that policies are written properly, and then that insurers are providing the proper service, and indeed education, because you need to train people, but you need also to train, to educate customers as well as insurance providers. Particularly in companies, it's important for all companies which are most exposed to all type of risk, as we have seen. It's very important for them to have a kind of insurance expertise inside the company, particularly when these are large companies. We cannot expect small-sized companies to have this expertise, but at least in this case, for small-sized companies, there is an important role for intermediaries such as brokers or insurance agents. And as I said, that may be a problem in a country like yours. So education is a key element also. Okay, so you see, I think with this graph, it's rather clear. It really shows you the first of all the link between insurance and economic development, and how negative influences can be balanced by positive influence. And there's the need to have a proper insurance policy. When I say policy, a policy by the government in favor of the development of the insurance system to make sure that negative influences will not play too strongly. So now a few numbers to illustrate the fact that insurance is an important activity. You see on this graph that which showed the real premium growth on the vertical axis and the GDP growth. So you see that there is a link, but you see that in many countries, the dots are in the green area, which means that in most countries, insurance growth is higher than the GDP growth. This is what economists would call a kind of a superior good. A superior good is when the growth of the activity of this market is higher than the economic growth. In other words, this type of activity, insurance in this case, benefits more from economic growth than other activities. Okay? Now, let's look at the evolution of the market over, if you look at the prospects between 2017 up to 2030. These are projections made by Munich Re. Munich Re is also a big reinsurance company providing a lot of studies, very interesting studies. Again, you have the web link here. So you see, if you look particularly at your area, emerging Asia without China, that would include Vietnam, you see that you can expect a rapid growth, okay, up to 2030, which is another way to illustrate the potential of the insurance activity in a country like yours. To be more precise on that, let's look at the position of Vietnam. Here you have a graph with insurance penetration. Insurance penetration is a measure of insurance premiums over the GDP as a percent. You see, and it showed that again you have a link. You know, the higher the GDP, indeed, usually the higher the weight of insurance in the economy with a curve like this. So where is Vietnam? Vietnam is there. You still have a long way to go, but that's why, you know, you will understand why I'm arguing that you can expect a high and rapid growth in your country, because you should move on the blue line. Okay? You should move on the blue line, and normally you should reach a situation which would be around there, and to move up to here, okay, up to, let's say, close to 4, it may not take that much time. So you can expect a very rapid growth of your insurance activity. let's be more precise even, looking at numbers for different countries in your region. This is the insurance premium per capita per head, which is what we call insurance density. These are numbers for 2018. And you see that for Vietnam, for instance, you have a value of 74 per head. Okay. And these are in, I didn't mention it, but it's in dollars. Okay. Sorry, I should have mentioned that. With mostly life insurance and a very low level in non-life. And you can see that if you compare with all the other countries which are there, okay, you have a total which is on average of 195, close to 200. So you see, whereas you are only at 74 for the total business. Okay, so you have a certain way to go, and it's also lead to the conclusion that you can expect a high level of growth in the future, because there is no reason why you should stay such a lower level in the region. You are growing faster, for instance, than Indonesia or the Philippines or Sri Lanka. Okay, so you will probably in the future you can expect to be closer to countries like China or Malaysia or Thailand. Okay. If you look now at the insurance penetration, that's the same figure as before, total premium as a percent of GDP, still in dollars, you know. Again, you see that you have a level which is lower than the average for the total business, and particularly for non-life business, 242, whereas for the average is close to 4 with 383. Okay. And what can be the future for you? Let's look at your growth prospect more precisely. I told you that it might be high. Let's make these assumptions for the 10 years to come. Let's assume that your GDP growth per year would be 5% growth per year, which is a reasonable guess. Okay. What about your penetration rate? Today, it is 242. Let's assume that in the 10 years to come, you will be able to reach the average, which is reasonable. The average is 383. So in other words, here I'm assuming that it will take 10 years for Vietnam, considering the position of Vietnam today, its role and its growth rate in the past. Okay, if you forget about COVID-19, okay, let's assume that in 10 years, you will grow, your GDP will grow by 5% year after year, and that your insurance penetration will move from 242 to 383, which is the average today. Okay. If you do that, you conclude that the total insurance business will grow by 10% per year. Okay. Which is, I think, a conservative estimate of what might be the growth rate of the insurance business for the years to come in Vietnam, you see, which is twice the assumed GDP growth. Okay? That's why I think that you should have this in mind. You may have to consider that, you know, the insurance business might be an interesting area for your career in the future. Okay? And that's why I think this course is useful, not only because it's part of the knowledge you need to acquire to be well prepared to deal with the financial world of today, of tomorrow also, okay, but also because it might be very interesting for yourself if you think of your future career because of the growth prospect. So is that right? What do we observe? Insurance premium growth in real terms, you know, and that's a very recent number from 2020. What was the growth rate? You see Vietnam, you are there. The growth is in the green, dark green area. The dark green area is for more than 10%, okay? Which shows that you're in real terms, which means that we look at the growth excluding inflation. Okay, so you see, it's clearly, it's totally in line with the simulation we have made before, and it reinforced my conviction that you can expect a very high growth rate in this business for the years to come in your country. Okay? Well, so I hope now at this stage you have understood what the insurance business is all about. Okay? What is an insurance policy? I think you have also understood, I hope you also have understood, it's a very important activity today, particularly in a country like yours, because it contributes to economic development, but also because you experience a rapid economic development, it will also necessarily boost the insurance activity in your country, so that you can expect high growth rates in the range of 10% for the years to come. Hence the importance of your activity, this activity, and the importance for you to know about it. So now we need to go a bit deeper in the insurance business to have a deeper understanding of what it is, so that we can later on tackle more specific technical insurance issues such as pricing. So, insurance model, a portfolio approach. Let's look at it more precisely now. Let's describe an insurance activity. Insurance, what are they doing? They are providing financial security. That's one aspect of their activity, which is what we call the underwriting activity. Well, actually, let me tell you the story about the origin of this word underwriting. You underwrite an insurance policy, okay? And you have underwriters. It started with the Lloyds, which I mentioned before. You remember the Lloyds, they were taking risk. They were the first insurers, which were called insurers. And they were covering the risk for the ships going through the seas to bring back all types of materials and to make a huge amount of money. And, you know, all that was taking place in a big pub in London near the harbor. And a group of people came together to take the risk. They were risk takers. The first insurers were risk takers. And they had a piece of paper where their name was written, showing that they did agree to take the risk together. And each participant had to write under the stipulation of the risk taking. They have to write under their name, hence the expression underwriting. Okay, so it comes from here. So underwriting activity has to do with the activity of providing financial security by the sale of insurance policies. So insurance underwriting, if you want to describe it, what can you say? It is a transfer of risk from the policyholder to the insurance company. Okay, so policyholders, they transfer the risk to the insurer, and the insurer transforms the risk into financial security. You give your risk to the insurer, and instead you get a financial security, which is represented by the insurance policy. Okay? In other words, you see that the insurance company will transform the risk into safety. That's where the main value added of the insurance comes from. They transform risk into certainty to a certain extent, or let's say security. And I had financial security because what they provide is a financial compensation to cover the damages, the cost of the damages. Well, so this is one way. Now, insurers are not doing that for free, indeed. They need to collect premiums. Why do they need to collect premiums? Because they need money to pay claims. Okay? So if they collect an amount of 100, okay, well, they will use part of this money to pay claims because of the occurrence of accident. The claims payments can be seen as the cost of the risk the insurers have taken. The insurers are taking risk, they are buying the risk and they pay for it because they pay claims. So they have to cover the cost of the risk, but they provide financial security by selling a policy And because they sell this service of transforming risk into security, they receive an insurance premium. So we can say that there is an underwriting value added, which is 40. You might tell me, but it's a huge amount of money. Well, you have to cover the cost of underwriting. You need a lot of people at work. You need a lot of legal aspect with specialists and so on. People would criticize saying it's high, but we'll see that it's usually smaller than this for some cases, but sometimes, it's fair enough because there is a cost of providing insurance. Okay, so this is the underwriting aspect. Now, is it the only aspect of the insurance activity? Indeed, no. Why? Because there is a lag, a time lag, between the moment when the premium are collected and the moment when the claims are paid. Okay? During this period of time, which is more or less long, it depends which risk you are considering. During this period of time, well, the money will not remain somewhere in the pocket of someone. No, the funds will be invested. Okay? So because of this time lag between the moment when the premium are collected and the claims are paid, there is a kind of amount of money which is available. Okay? It is very much, by the way, like a negative working capital. You have a bit the same system in retail business. When you go shopping, you pay cash. Okay? When you buy goods. But the retail company would pay suppliers later. That's why retail companies are cash rich. Insurance company, they are also cash rich. Why? Because they receive premium first and they pay claims later. So this delay generates a certain amount of funds which insurers will be able to invest. And that's why they are not only providing security. Provision of financial security is one aspect of their activity. It is the underwriting dimension. But they also have a financial activity because they are investing the money they have collected from the policyholders. And this money can be seen as precautionary saving. In other words, what I'm saying is that when you buy insurance, when you pay a premium, this premium can be seen as money which is saved by the insurer to be used later on to pay claims. Okay? So the financial activity corresponds to the fact that insurance companies are investing collective precautionary saving, and doing so, they finance the economy. So the other aspect can be described this way. The other activity is not underwriting, it is fund management. By their activity of underwriting, they collect precautionary saving. And this precautionary saving is used to finance, to provide another service, which is the provision of finance to the economic agents, which is what we call financing. Indeed, when you finance, if you buy shares or bonds, you will receive a return on that. You have a financial income, but one way or another, that's why I write that the cost of funds is explicit or implicit. It is explicit in life insurance. One way or another, you will provide part of this remuneration to the policyholders. In other words, sometimes policyholders are not quite aware of it, as we'll see, but the saving one way or another, this saving, which we sometimes call the insurance funds, okay, they are not free. They may have a cost, okay, which is a cost of funds. I assume here that it would be 15. So they would have a financial value added of 5, which will be a complement to the underwriting value added, which we had before. Okay, so an insurance company is a mixture of two activities. Okay, on one side, they provide security. On the other side, they are financing the economy. Okay, and it is reflected in their balance sheet. Okay, what do you have in their balance sheet? You have, on one side, an underwriting portfolio. which is made of what? Policies. I told you that each insurance policy should be seen as an asset, a financial asset, a financial instrument issued by the insurance company. Okay? And by doing so, the insurance companies provide the financial security, but also collect money. Okay? And there are many policies, different policies for different type of risk. And each time the company is taking a risk, selling a policy, they need to write a provision for this risk. Okay? This is what we call technical provisions. Sometimes we say underwriting provisions or insurance funds. And these technical provisions, what is their value? It corresponds to what insurers feel they need to pay claims. So it is an estimated debt towards policyholders. It is an estimation of what they feel is needed, what they think, what they predict is needed to pay for claims. Okay, but I write it is an underwriting portfolio because it's made of many different types of policies. Okay, corresponding to different group of risk, different types of customers. So there is a large portfolio, and indeed, as we'll see, they can benefit from diversification there. By doing so, by selling policies, indeed, as we've seen, insurers collect saving also. They collect money. So there is another block on the asset side, because if they invest money, it means they buy asset with the money they have collected in the first place. So on the other side of the balance sheet, they have investments. They have an investment portfolio, which might be made of shares, bonds, real estate, any other asset you would like. Okay? So you see an insurance company, if you look at its balance sheet, can be seen as a joint portfolio. An underwriting portfolio, okay, which corresponds to the amount of funds collected by the insurer. And on the other side, an investment portfolio, which corresponds to the allocation of these funds in different types of investments. Okay? So the final position of the company will come from the combination of these two portfolios. The first, on the asset side, the investment portfolio will generate a financial income, and the underwriting portfolio will generate an underwriting balance. I should write an underwriting result, okay? And they are combined together. And that will generate, indeed, the total combination, the total portfolio, with a certain expected income and a certain level of risk. Okay? So it's important for you, for a better understanding of the following, to have this clear understanding of the two aspects and the structure of this balance sheet with these two portfolios on both sides, hence the relevancy of an ALM approach. I'm using the expression ALM because I'm assuming that you know what it's about. It's asset liability management. It is a concept which is very much used in banking. It can also be used in insurance, as you can see, because the job of insurance, of the insurer, is to manage jointly these two portfolios, portfolio on the asset side and on the liability side. Hence the relevancy of this expression, asset liability management. Okay? Well, now let's look at a few data to show you more precisely what is the structure of the balance sheet of insurance companies with numbers. And it's interesting also because you also have a lot of courses on banking to compare between banks and insurance companies. The difference, the specificity of an insurance company is what? It's the origin of the funds. Banks, if they want to get money from their customers, well, they allow customers to open current account or saving accounts and so on. Insurance companies, they issue insurance policies to collect the saving. And it's a specific case of saving. It is precautionary saving. Whereas banks, it would be more like, let's say, treasury saving. Okay? So on the left side here, you have a typical balance sheet for a bank. You know, capital and reserves. That's a certain amount of equity which is needed and regulated. You have debt securities, deposit from monetary financial institutions, deposit from customers and government, and other. Total liability and equity. Okay? That is the liability side. You see the big difference with, and it's, well, you know, you have three blocks which are not exactly, the four blocks are not exactly equal, but you see that to a certain extent they are rather very similar proportions. Okay? It's totally different for the insurance system. If you take life insurance, for instance, you see that the deposit from monetary financial institutions, technical provisions, excuse me. The technical provisions, the big block here, blue, is the dominant part in the total insurance business. Okay? Capital is, as we'll see, regulated. Subordinated liabilities, I guess you know what it is. It's kind of, we call the quasi-equity sometimes, but it could be aggregated with equity. But the main source is technical provisions. Technical provisions is what is coming from policyholders. That's a precautionary saving collected by policyholders. You see there the big difference with the banking system. It is the origin of the funds which insurance companies will have to manage. Okay? And as you can see, it is even more important for life insurance and a bit less important for non-life insurance, where, as you can see, in non-life insurance, you have much more equity. Why is it so? Because non-life insurance is a much riskier business than life insurance. Because it's a risky business, regulators tend to impose higher level of equity, and insurers, without the regulation, they like to have a higher level of equity to maintain a safe balance sheet. Okay? So here I think you have a good view of the differences of the funds. Well, what I would say also is that when you look at the difference between banking and insurance, is that the technical provisions can be seen as a risky debt. Why? Because it's just an estimate of the amount of claims you will have to pay, an estimate, which means that it's not a value for sure. If you look at banking, deposit from monetary financial institutions, deposit from customers and government, you know the amount on the deposit for sure. You know exactly what is the amount of your debt. So the debt is known, I would say, nearly for certain for the bank, the liabilities. It's not true at all for the insurance companies. And that's a major difference. The technical provisions, which represent the main liability of the insurance business, are just an estimate. It's not known for sure. And that's particularly true in non-life insurance, which explains why in non-life insurance, because the liability is even more uncertain, that's why they have more equity. Okay? So, having said that, now we are ready to go a bit further into how insurance companies work. With just, I thought it was interesting to look at a very simple simulation. I want to reassure you because I just realized that we have just 4 minutes left. I'm not going to do that right now, but maybe I can just show you that we're going to do. You know, we're going to imagine the launch of an insurance company. Okay? With all type of data concerning the level of equity, the paid-in capital, the amount of premium you receive at the beginning of each year with a growth rate. What about the operating expenses? What about the losses? Expected loss ratio, 72%, which means that the estimate is that 72% of premium will be paid later on as claims at different dates and so on. So I'm not going to comment that precisely because this is what we are going to start with in the next session. So the next session is, if I remember well, on Saturday. Is that right? Okay, so I'm just trying to write something for you. So see you Saturday. 8 a.m. French time. Have a good dinner. See you guys.
You are currently the only person in this conference.